So today we're going to talk about the truth about hard money rates. How do you actually save a little money on hard money? So do you ever wonder why two investors send in the same deal, get different terms, different rates, different LTVs and get it done faster? We want to make sure you're on the fast track and get the best terms you can for hard money. So why are hard money rates all over the board? Because number one, it's not a bank. This is not a big Wall Street firm that's giving you this money. Rates are going to be different depending on who you talk to and where you look. But most important, it's going to be about you and your deal. And that's why you're going to find one lender will give you 9.5 and one maybe give you 13.5. One will give you 70% LTV and one will give you 75% ARV. This is your business. You have to shop around. You have to look for the best terms for your deals. And how do you attract more of these lenders? And how do you attract the best rates? First of all, it's knowing the lenders in your market and what kind of deals they want, and then really taking the time to present it correctly. Because yes, they're going to want to know your experience, your liquidity, but the most important thing they're going to want is a good deal. Just like you, they want a good deal. So the better you present it, the better your term's going to be. So step one is just understanding that this is a segmented market. Every lender has their own guidelines, their own wants, and they're really their own bucket of money. So when their money kind of dries up, they're going to be a little tighter on the deals they're looking at. So here's the 4 biggest mistakes that real estate investors make that drive up the cost and the terms of their loan. Number one is not having the numbers ready. When you're submitting this to a lender or you're discussing it with a lender, they want to know that you understand this deal frontwards and backwards. So before you submit to a lender, know exactly what you're getting into as far as the ARV, your scope of work, and your budget with that, and your time frame. Know your numbers before you submit, because honestly, this is going to signal to the lender if you're someone they want to lend to or not. If they're going to go out of the way to make sure they get you the loan or the money, the terms that you're looking for, or they just put you at the end of the pile. Be prepared so your lender wants to lend you the money. Number 2 is make sure you have the liquidity to finish the project, to make the payments, to do whatever you promise that you're going to do on the loan. Liquidity plays a big part in underwriting for a hard money lender. Why? Because they want to make sure that you're going to be able to make the payments. And when that surprise pops up, that you're going to be able to cover it. It's not going to put you back another 3 to 6 months. So make sure you're liquid to make the payments and to take on any surprises that pop up. Number 3, make sure your ARV is spot on. Make sure you're looking at like properties with square footage, beds, bathrooms. Does it have a garage? Is it in the same location? And are you using the comps that are closest to your property? Because all a hard money lender wants is that it to appraise for you to refinance or when you sell it. And you just have to understand the rules here. When you go to sell it or refinance it, it goes into the hands of the appraiser. The appraiser has to go by national standards. So they're going to have to look at comps that are like it, as close as it, and in the same either subdivision or property type, like a single family compared to a duplex, or even more like a ranch compared to a triplex. All of these things matter. Make sure you know your ARVs backwards and forwards, because the biggest part of real estate investing is buying right. If you buy right, you could fix almost any problems that come up. And if you buy right, you're just going to make more money. And real estate investors and hard money lenders really want to see a solid ARV. The number 4 mistake when you're shopping for a hard money lender is not knowing what their sweet spot is. What do they like? Some people like small commercial. Some people like condos. Some people like rural properties. Some people just like city center. Some people like smaller loans, like 200,000 or 300,000. Some like larger loans. You have to understand the deal that you have and the lender that you're looking at. Do they match up? Do they fit the bucket that they're looking at? And if not, you just got to find the lender that fits the deal that you're looking at. And this comes into play because you may find a land deal. You may find something that's more unique. You might go to a 4 to 6plex instead of the single families you're usually doing. Make sure your lender likes the kind of deals that you're sending them, because it may give mixed signals. You may send them in and they may go, doesn't fit. It's not for me. I don't like this deal. And it's just because that's not the kind of deals they lend on. But how do lenders actually price a deal? And it's going to come down to, like I said before, your experience, the kind of deal that you present to them. Does it fit what they're looking for? Do they have the money available? Do they have extra money that they want to get out quickly, because if they have more money available, that means they're going to probably be a little bit easier on the pricing, probably give you better terms. But if they don't have a lot of money, they're going to be very picky. They're going to want the deal that fits them. They're going to probably price your deal higher or just give you the terms that you're not looking for. Maybe you need 10 or 20% in instead of 100%. So remember things like this. The more experience, you're probably going to get lower rates, better terms. The more experience, especially with a lender, you're going to get lower rates and better terms. The lower the amount of the loan that you are requesting will get a lower rate and better terms. Knowing your exit strategy, knowing your ARV, giving them a clean file are more likely to get you those better rates and better terms. So just understand, for a lender, it's not emotional, it's just math. Where can they put their money, get their interest back, and make sure they can get on to the next deal, that it's not going to drag out, that there's not going to be issues with it, that they're not going to have to worry about collecting funds and payments. They want, just like you, a fast, quick deal. So the more that you can show them that up front, that you understand your numbers, that you understand the market, and you understand how to get a property from start to finish, the better you have for negotiating rates, terms, LTVs. So here's another way that they're going to give you better terms or rates is the loan to value. If they don't have to cover the repairs and you have all the money, or if you're going to put 10, 20% down and cover the repairs, the lower the risk to the lender, the better the rates and terms that you're going to get. When you're out there and you're looking and maybe you have a HELOC, or maybe you have some credit cards or other ways to lower your costs, because it's a lot cheaper to borrow from a HELOC for the 10 or 20% or for the actual work, the repairs that are being done, than borrowing that all from the lender. When you're shopping and you have the money available, maybe you have set up these lines of credits and everything, use them. Don't overextend them, but use them to get better rates and better terms. Cut off a point on the interest rate. Cut off a point or half a point on the origination. All of those things add up, because if you're paying 7.5 on a HELOC with no points compared to 10 or 12% on the interest rate and an extra point, you're going to cut your cost, put more money in your pocket, and just make this whole process easier for you to find the money you're looking for. And an easy way when you're talking to lenders, just know their breakpoints. If I put in 10%, what can you give me? If I put in 20%, if I put in 25 and cover the rehabs, what are your rates and terms when I could do something like that? And then just do an average. I mean, like, what's it going to cost me on each level when I use a HELOC, when I use a credit card, especially if you have 0% credit cards, especially if you have HELOCs out there with the rates going down, maybe at 7.5 or 8% now with no points. That's a better deal for you overall. So know the break points for your lenders when you put in 10, 20, or 30%. What does that mean for your cost of funds? And remember, when you're shopping for hard money is completely different than banks. Of course, banks are going to have their positives and negatives. Positives, probably a better rate, probably better terms, the longer term, but you're just going to have to provide more information, from the tax returns to your work history. And then you're going to have to be able to wait 30, 40 days to get that done. Every lender has their spot where they can help you out. Hard money is typically going to cost you a little bit more than banks, and even more than what we call Wall Street money out there, but it's going to give you better flexible terms of maybe higher loan to values, different kinds of properties, different positions, meaning maybe a first, maybe a second, maybe a cross lien to get something done. There's flexibility with hard money. And even though on the surface it's higher priced, it can save you a lot of money, because if you could actually close a deal in 2, 3, or 4 days compared to 45 days, if you could close a deal with, less money in, so you could do another deal, or if you could close a deal that's just outside the box, because remember, Wall Street private money, if you don't fit in their box, they're not going to do it. So if you have something unique, you have something that you need to finish your project, that's where hard money comes in. If you're looking for the best rates out there, make sure you have the deal dialed in. Make sure you know all your numbers, from your scope of work, purchase price, especially ARV, and how long is it going to take? What is the budget, and what is the realistic budget? And does your exit strategy make sense? Does your refinance make sense if your credit score is 640? Make sure your credit score is in line. Does your sale price make sense when you're putting it on the market? Make sure your exit strategy lines up, and when the lender looks at it, understands that that's a good business plan. And we have you covered here. If you're looking out there and you're shopping for deals from banks to private money to hard money, we have this free tool, Loan Cost Optimizer. We'll put the link below. Check it out. You can add 3 or 4 different scenarios compared to how much each will lend you to the cost. Because some people will charge you more points and a lower interest rate. Some will give you less, but you can't afford it. So you got to look at the cost for each project. Each project's going to be different. Download the Loan Cost Optimizer. Make sure you're getting the best deal on every deal and shop on every loan that you're looking for.